This question tests the conceptual distinction between joint products and byproducts, which arises in process costing and joint cost allocation. Key ideas. A joint products are two or more products that are produced simultaneously from a common input/process. Have significant sales value. Are equally important outputs of the production process. Byproducts are secondary or incidental outputs. Have relatively low sales value compared to joint products. Are not the primary focus of production. The key issue is how accountants distinguish between the two. There is no physical or technical difference in production, so classification depends mainly on economic significance. The most important factor is the relative market value at the split-off point. Products with significant market value are treated as joint products, while those with minimal value are treated as byproducts. A. Historical costs. Incorrect. Past costs do not determine whether a product is classified as a joint product or byproduct. B. Prime costs. Incorrect. Prime costs, direct materials plus direct labor, relate to production cost structure, not product classification. C. Market value. Correct. The distinction between joint products and byproducts is largely based on relative market value at the split-off point. Products with substantial market value are classified as joint products, while those with insignificant value are treated as byproducts. D. Salvage value. Incorrect. Salvage value is not relevant to classification in joint processing. It relates more to asset disposal. Correct answer. C. The classification of outputs from a joint production process depends primarily on economic significance, which is measured by market value at the split-off point. Products with significant market value are treated as joint products, while those with minor value are classified as byproducts. This question focuses on the classification of joint products versus byproducts in a joint production process. In cost accounting, multiple outputs are produced simultaneously from a single input or process up to a split-off point. Key concepts. Joint products have significant economic value, are considered primary outputs, receive a portion of joint costs for inventory valuation purposes by products, have relatively minor economic value, are incidental outputs of the production process usually accounted for using simplified methods, e.g., net realizable value or other income treatment. The key issue is that there is no physical difference in production process between joint products and byproducts. The distinction is based on economic importance, not technical or cost allocation methods. A. Relative total sales value of the products. Correct. The main criterion for distinguishing joint products from byproducts is their relative sales value at or near the split-off point. Products with substantial sales value are classified as joint products, while those with insignificant value are classified as byproducts. B. Relative total volume of the products. Incorrect. Quantity or volume does not determine classification. A low-volume product can still be a joint product if its value is high. C. Relative ease of selling the products. Incorrect. Marketability may influence decisions, but it is not the primary classification criterion. D. Accounting method used to allocate joint costs. Incorrect. The allocation method depends on classification, not the other way around. Correct answer. The distinction between joint products and byproducts is primarily based on relative sales value, reflecting the economic significance of each output, not production volume or accounting treatment. This question tests knowledge of joint cost allocation methods used in process costing where joint products are produced. Joint costs are incurred before the split-off point, where multiple products become separately identifiable. Since these costs cannot be directly traced to individual products, they must be allocated using systematic methods. Key idea: the question asks for the method that is not used in allocating joint costs. Common accepted methods include: physical quantities method allocates joint costs based on physical measures such as weight, volume, or units produced. Net realizable value (NRV) method allocates joint costs based on final sales value minus separable costs incurred after split-off. Gross market value method allocates based on relative sales value of products. These are standard approaches used in managerial accounting for assigning joint costs for inventory valuation and financial reporting. However, one option refers to a concept that is not a joint cost allocation method. Physical quantities method. Incorrect. This is a valid joint cost allocation method based on measurable physical output. B. Net realizable value method. Incorrect. NRV is a widely used and accepted method for allocating joint costs. C. Separable production cost method. Correct. This is not a joint cost allocation method. Instead, separable costs are additional costs incurred after the split-off point for further processing. These costs are assigned directly to individual products, not used to allocate joint costs. D. Gross market value method. Incorrect. This is a valid method based on relative sales value. Correct answer: C. The separable production cost method is not used to allocate joint costs. It is used to assign post-split-off costs to individual products, whereas joint cost allocation is done using methods like physical units, NRV, or sales value methods.